In this lecture, we will cover the CFA Level 2 reading on industry and company analysis. This is an extremely important reading and it covers many areas from the CFA curriculum. So it connects economics with financial reporting and analysis with equity. And the purpose is this. As an equity analyst, one of the most important things for you to do is forecast numbers for companies that you are evaluating. Obviously, when you need to make a buy decision or a sell decision, you need to forecast revenue, costs, net income, cash flows, balance sheet numbers. And this reading helps you figure out how to forecast. And specifically in our line of work, you will keep hearing this term financial modeling. And this is a primer on financial modeling. In the context of financial modeling, what we are going to start out with is your basic financial statements. So how do you take the income statement and how do you forecast the income statement, which effectively is income statement modeling? Then how do we model the balance sheet and cash flow? And then we'll briefly talk about the concept of scenario and sensitivity analysis. One of the most important things to forecast and model is the revenue. So the top line in the income statement. A lot of financial models are based on revenue projections. So let's say that you need to evaluate a company and you want to forecast revenues. So obviously you look at several sources, but one of the most important sources to look at is the company annual reports, the company disclosures. Some companies might be focused in a given geographic region in a particular segment, but many large companies will be operating across multiple geographies and they might have multiple lines of business. So you as an analyst need to understand that. If you take the example of BMW operates in various parts of the world, but it has 4 major geographic segments. Obviously it's based in the Eurozone, it's based in UK, based in America and China. So as an analyst, you might want to take each of those regions separately and forecast because the dynamics in China might be very different from the dynamics in the UK. So basic point is understand the geographic distribution, business segment, product line. So how do these various categories contribute to revenue? In fact, the better way of putting it is if you have geographic distribution, then how do the different parts of the world contribute to the revenue? How do the different segments contribute to overall revenue and so on? In terms of learning objectives, what is emphasized is that you need to understand the distinction between a top-down approach to revenue forecasting versus a bottom-up approach. And then obviously there is always a hybrid, which is a combination of the two. So let's talk about these approaches, starting with the top-down. Within top-down, there are different types of top-down approaches, but the principle behind top-down approach is that you start at the level of the overall economy. So economy, industry, and then company. So what are the different sub-approaches? Approach 1 is that you figure out the GDP growth rate. So at what rate is the overall economy growing? And then you determine your company, your target company sales relative to the overall growth rate. So obviously the first thing to do then would be for a particular region. Let's say that you are evaluating BMW's sales in China and you are estimating that the sales growth is dependent on the GDP growth rate. So clearly then you need to estimate China's GDP growth rate. You could either directly forecast the nominal growth rate, or what might be a better thing to do is recognize that the nominal GDP growth rate is a function of the real GDP growth rate and inflation. So you might forecast the two separately and then put this together. Then once you have forecasted the GDP growth rate, then you forecast the revenue growth relative to GDP depending on the company's position in its life cycle and or business cycle sensitivity. So what does this mean? If you have a company that is relatively young or an industry that is relatively young, then obviously its growth rate is likely to be higher or faster than the rate at which the economy is growing. That's one scenario. Another scenario is a company such as a pharmaceutical company like say Pfizer might not be that sensitive to the business cycle. So you might have a situation where the economy is growing slowly. So as far as our business cycle is concerned, the growth rate has slowed, but the pharmaceutical sector is not impacted that much by the slow economy. So you need to make those adjustments. Obviously, the starting point is the overall economic growth rate, but you make adjustments. And broadly speaking, there are two ways in which you can make the adjustment. One is to say that, okay, the economy is growing at 4% currently, and you say that Pfizer's revenue growth will be 100 basis points above the overall economic growth rate. So you are just adding a premium for this particular company. So you then estimate that, look, overall economy is growing at 4%, and I estimate that Pfizer will grow at 5%. That's one scenario. Another scenario is where you take a relative number. So again, let's say that the American GDP is growing at 4%, and you say that Oracle, which is a tech company, is going to grow at a 25% rate faster than the overall economy. So then you can say you estimate Oracle's growth to be 4% into 1.25, which is 5%. So there are different approaches that you can use. The other top-down approach is to start with a given industry or a given market, estimate the market growth, and then figure out how your target company's market share is going to change. So I'll give you a simple example here, going back to our BMW discussion. Let's say that you define a market, and that market is the luxury car market in China. What will you do here? The first thing that you will do is figure out the current size of this market and figure out how this market is growing. Then you say, okay, BMW's current market share is whatever. I'm picking this number. Let's say that market share is 20%. And you forecast whether this market share is changing or not. So the curriculum has a few basic examples on this. It is fairly straightforward mathematics. Then we can also use bottom-up approaches. These begin at the level of an individual company or a segment or a business unit. And there are several approaches here. One possible approach is a time series approach. So we might look at the company sales in the past and then project those numbers. This connects with something that you saw in quantitative methods, where we talked about time series analysis. And we said that, look, this particular company, I think it was Intel, has these sales over the last few years, and then you use a time series based regression to forecast sales in the future. You could do that at a company level, or you could do that at a business segment level for a given company. You could also use return on capital. Now here what you can do is forecast balance sheet numbers and then use ratios or rates to say, okay, with so and so capital or with so and so balance sheet numbers, given the forecasted ratios, here is what we expect sales to be. They can be capacity based measures. So this is used often in the retail sector. If you want to predict Walmart's sales growth rate, you can do two things. One is you will say, okay, with Walmart, what is the increase in same store sales plus what is the increase in number of stores going to be? That's also a bottom-up analysis. Now, the most common thing to do is to combine both, because in any form of analysis, you as a financial analyst are not constrained. You don't have to use one method or the other. So most people actually use a combination of methods. And that is what is stated here. This is straight from the curriculum. Hybrid approaches combine elements of both top-down and bottom-up analysis. And in practice, they are the most commonly used approaches. For example, the analyst may use a market growth and market share approach to model individual product lines or business segments, and then aggregate the individual projections to arrive at a forecast for the overall company, because the sum of the forecast segment revenue equals the segment market size multiplied by the market share for all segments. So this could happen on a segment basis or it could happen on a geographic basis. If we go with my BMW example, if you are taking China, Europe and US as three separate regions, and then you are doing a top-down analysis within those regions, what you are really doing is hybrid, because First, you are taking the company, breaking it into geographic regions, and then within each region, you are doing a top-down analysis. So that's a hybrid. If you are studying a large pharmaceutical company, what you might do is take, the insulin-based product lines, some other business segment, and then model those or forecast those separately. So that example is actually right here. You have a company called Novo Nordisk. So this is a Denmark-based biopharmaceutical company. This is actually a long example. I'm just giving you a very small excerpt from here just to illustrate one particular company's disclosures. Notice that this company discloses sales by geographic region, and then they also disclose sales based on different kinds of segments. So this is, insulin and essentially diabetes care. Then there will be other segments also. Generally, if a given region contributes to 10% or more, then companies disclose that information. So what are the sorts of questions that you might get? Example 2, or at least the excerpt from example 2 that I picked, is what you are likely to see on an exam. So I want you to try this before you look at the solution. The answer to this question is that it is a hybrid approach, because we are taking one segment, which is the diabetes segment. So that makes it look like a bottom-up approach. But then we are looking at the global GDP growth rate and forecasting based on that. So uses both top-down and bottom-up. So it's a hybrid approach. The next question is, based on revenue growth, calculate the estimated revenue growth rate for diabetes care segment in 2013. Based on information in the previous disclosures, we are given that in 2011, so this is 2011, the company's growth rate, by company I actually mean the diabetes care segment's growth rate was 11%. So this is for the company. But what about the world? WHO projects that the nominal GDP will be at 5%. So let me just put that here, 5% for nominal GDP. Now coming to the nominal GDP for the world, that's 5%. Plus the incidence of diabetes is accelerating, so he is adding 100 basis points to that, so plus 1%. So he is saying that in the long run, the growth rate of this market is equal to 6%. Then we are told that WHO believes the revenue growth rate of the company's diabetes care segment will decline linearly over the next 4 years from its growth rate in 2011, which I have told you is 10%, and you could calculate this from the previous disclosures. So it's going to decrease. So this is 2011. Then over the next 4 years, so this is 2012, 2013, 2014, it's going to decrease to 6%. So that means here it's 10%, then over this year it will come down to 9%, 8%. So for this year, the growth rate is 8%. Again, fairly straightforward once you have understood what to do, but as I keep saying, you need to practice these sorts of questions if you want to do well on the exam. Speaking of practice, I'm not going to do it here, but example 2 has a part 2, which you need to do. Once you try this and you look at the solution in the curriculum, it is fairly self-explanatory. So what we have done so far is learnt about how to model the top line. Now we come down the income statement and we'll talk about operating costs. We'll make a few high-level remarks and then we'll go into the subset of operating costs. If information is available, try to match your cost analysis with your revenue analysis. In other words, if you are doing your revenue analysis based on different geographies, then try to match your cost to each geography. If your analysis is based on business segment, then try to match your cost with each business segment. But what's the problem with that? Problem is, while companies often disclose revenue based on geography or based on segments, as we just saw, companies don't often disclose cost information the same way. So very often you need to do some estimation. Again, as far as estimating cost, you can use a top-down or bottom-up. approach. And this is important because most people think of top-down, bottom-up in the context of revenue. But even in cost estimation, this concept of top-down and bottom-up does exist. Why does it exist, or how does it exist in the context of cost? If you think about the cost that a particular company faces, one way of estimating that cost is to figure out what are the major inputs or the raw materials for a given company, and then determine the overall inflation or overall industry costs, and use that information to estimate the costs for a company. That would be a top-down approach. A bottom-up approach would be to start at the company level and try to estimate future costs. High-level remark is that variable costs tend to increase directly with revenue, increase or decrease with revenue. That's why they are called variable costs. And fixed costs are not directly related to revenue. There obviously is a relationship, but that relationship is not as direct. This is a critical point which is emphasized in the learning objectives. If you are evaluating a company, how do you figure out whether the company has economies of scale? And I'll just quickly refresh your memory. When we talk about economies of scale, what we are saying is that if the number of units produced is increasing and the average cost per unit is coming down, then we say that the company has economies of scale. So how can you look at some of the numbers that companies disclose and determine whether or not we have economies of scale? What you do is look at the correlation between operating margins and sales. If this correlation is positive, then we have economies of scale. And what does that mean? A positive correlation means that as sales are going up, the operating profit margin is also going up. Operating margins going up means the cost per unit is coming down, right? So if you see this positive correlation, then you can say that, okay, there is economies of scale going on over here. Now what you need to do is look through example 3 in this particular reading, which talks about approaches to modeling costs. One high-level remark I'll make here is that this is a very long reading. It's about 100 pages, and it is full of examples and exhibits and so on. The core material that you need to know actually is not that much. Most of this material you know anyway. So what this reading really helps you with is how to apply that knowledge. So depending on how much time you have, you can spend time on the examples, but at least the shorter examples where there are specific exam type questions, you must do those examples. Now we go into specific items under your operating costs. The big one for most manufacturing and merchandising companies is cost of goods sold. Generally, cost of goods sold has a direct link with sales. Pretty obvious. What you as an analyst need to do is understand the historical relationship between COGS and sales. Obviously, this will be different for different industries, different companies. For a particular company, you might figure out that on average, COGS is 30% of sales. This will help you forecast COGS once you have already forecasted sales. But if you have figured out that this is the historical relationship, do you just assume that this will stay the same in the future, or do you try and figure out whether there are some factors that might cause this relationship to change? You need to obviously do that analysis. If you can think of reasons why it will change, then model that. If you can't think of good reasons why this number will change, then you use the historical ratio. As I mentioned, for manufacturing and merchandising firms, COGS is typically a large cost. It is often the largest cost. So you need to be extra careful with the procedure that you use to estimate this. If you have a very small cost, then you don't need to be too concerned about your degree of precision. But if you have a cost that is a significant percentage of overall cost, then you need to be extra careful. And where possible, you might want to break your COGS into separate subcomponents and then forecast each component. You should also understand the impact of any hedging strategy that a company might have. Some companies rely heavily on commodities, and the price of the commodity on the input might be very volatile. Take an example of, let's say, a cereal manufacturer. What is their major raw material? Corn. Corn is a commodity. Let's say that the price of corn is very volatile. So what might a company do to hedge the risk of changes in its input price? It might use forward contracts, futures contracts. Now, why do you as an analyst need to understand that? You as an analyst need to understand that because that obviously has an impact on the cost of goods sold, and therefore this is important. Also understand the impact of passing the cost on to the customer. Now I'll give you a simple scenario where you might think that the company is passing the entire cost of an increase in input to the customer, but the margins are falling. So let's say that your revenue is 100 and COGS is 25. So what's the gross profit margin here initially? The gross profit margin is 75%. And then the cost of input doubles from 25 to 50. The increase is 25 and you pass that entire 25 on to the customer. Does your gross profit margin stay the same, go up, go down? It goes down. Why? Because now what you are doing is saying, okay, if you pass the whole cost on to the customer, you are now selling for 125. Of the 125, your COGS is 50. And your gross profit is 75. So your gross profit margin is 75 over 125, which is 60%. So you need to be careful about these little things also. Obviously, when you are evaluating a particular company and its profit margins, gross profit margins, also understand the gross profit margins of competitors. The other big operating cost is SG&A. Here again, you need to understand the relationship between SG&A and sales. Relative to COGS, SG&A will generally have a less direct relationship with sales. Again, there is a relationship, but it's not as direct. Very often for sales and general and administrative expenses, the largest component is sales related wages and salaries. You need to pay your salespeople, you need to give them commissions. That often is the largest part of this particular cost component, and this will actually vary a fair amount with sales. The other components, your IT costs, your HR costs, your various other support and admin costs, those might not be as correlated with sales. You as an analyst, since you are forecasting these numbers, you need to have a sense for how they change. Benchmark with competitors. So if you have similar players in an industry, figure out who has the highest SG&A, what is the benchmark. So the best companies in the industry, what is their SG&A relative to sales. And example 4 does this well for you. Example 5 then is a long example which talks about Unilever and takes you through all these items that we've been talking about. What about non-operating costs? So we've talked about revenue, we've talked about operating costs. Now, how do we forecast non-operating costs? Within non-operating, let's start with interest income. What does this depend on? Very simple. It depends on the amount of your investments and the return that you are getting on your investments. For manufacturing companies, this typically will not be much, but for banks and insurance companies and other financial institutions, this will be substantial. What about financing costs or financing expenses? Does this depend on sales? This will not depend on sales. Here you need to forecast the levels of debt and the rates that need to be paid, and then you forecast. So basically, how do you figure this out? You need to forecast debt and interest rates in order to come up with financing costs. And example 6 in the curriculum helps you with that. Then we come to corporate income tax. Does this need to be forecasted? Obviously, because ultimately you are concerned with how much cash is generated or how much net income is generated. That is obviously after tax. So within tax, you need to be careful. You need to understand the distinction between the statutory rate and the effective tax rate. The statutory tax rate is the legal tax rate in a given country. So in a given country, the statutory tax rate might be 35%. What is the effective tax rate? The effective tax rate is read off the income statement. It is the income tax expense divided by the profit before tax. Is this going to be the same as the statutory rate? Not necessarily. So for several reasons, these two numbers might be different. There might be some tax credits as we saw in financial reporting and analysis for multinational operations, depending on where they are operating, they might be operating in low cost or low tax regions, which will bring the effective tax rate down. So you need to understand this particular difference as you forecast future tax amounts. Another distinction is between effective tax rate and the cash tax rate. These are fairly similar, but the difference is cash tax rate actually deals with the actual cash taxes that you are paying. So the point to remember is when you are forecasting net income, then you use the effective tax rate. If you are forecasting cash flows, then you use the cash tax rate. A few other items, these are not emphasized in the learning objectives, so I'll just touch on them very briefly. But if you are concerned about forecasting your income statement, you forecast net income, but at times you might also be concerned about how much money is left after dividends are paid. So you might want to forecast dividends. So to forecast dividends, you need to forecast earnings, and then you also need to know what the dividend policy is like. Income from affiliates, if you recall from FRA, we talked about the equity method when we have investments in affiliates. So we need to estimate how much money is coming from there. When we have consolidation, then a part of the net income is allocated to minority shareholders. We need to understand that. If we are doing earnings per share calculations for the future, then we also need to have a sense for what the forecasted number of shares will be. All right, now we are done with the income statement. Let's move on to the balance sheet and the cash flow statement. Focus first on the balance sheet. So how do we forecast balance sheet items? There are several ways of doing this, but the method that is used most often and the one that is emphasized in the curriculum is to use sales numbers or use income statement numbers and then relevant ratios. So to forecast accounts receivable, if you can forecast sales and then forecast DSO, can you take these two numbers and then come up with accounts receivable? You can. How? What is DSO? DSO is days sales outstanding. So based on DSO, you can come up with receivables turnover. What is receivables turnover? So if you have a forecast that your receivables turnover is, let's say, 10, what is receivables turnover equal to? It is sales over average accounts receivable. So if you've already forecasted your DSO from which you can get the receivables turnover and you forecasted sales, where did this forecast come from? You've already done this with the income statement. Then you can forecast accounts receivable. Same concept with inventory. So use COGS, and where's this coming from? Again, this is coming from the income statement. The inventory turnover, this is what you forecast. And where do you think these forecasts will come from? You can use the company's historical averages or you can use industry averages. Now, does that have a flavor of top down or bottom up? If you use the industry averages, then you are using top down. If you are using the company's own historical averages, then you are using a bottom up. And you can also use this concept to forecast what will happen in the future. For example, if you are projecting that the economy will slow and you are projecting that sales will slow down and there will be a lower inventory turnover, that's what you are projecting for the future. This is a top-down approach. What about property, plant and equipment and depreciation? Will you use this as a percentage of sales? Some analysts do that, but the better thing to do is to consider the future need for property, plant and equipment. If you recall from level 1 and level 2, there will be disclosures that will show you what is the depreciation expense, what is the total life, and you can figure out how much more useful life your property, plant and equipment has. And that can be used to predict or forecast capital expenditures. So look at the PP&E and depreciation disclosures. Also estimate your maintenance related expenditures versus growth related capital expenditures. Clearly, this is partly an art, partly a science. You need to understand the industry and read the disclosures carefully in order to come up with these estimates. I don't think exam questions can be too difficult here because the information will be given to you. You just need to read it and make sense of it. How do you forecast debt? or the capital structure. If you have forecasted the assets, so essentially we have forecasted working capital, we forecasted property, plant and equipment. So effectively you forecasted your assets. Then if you have forecasts for your debt to equity ratio or forecast for the debt to capital ratio, a company has announced that it needs to have a certain capital structure, right? Or there is a capital structure historically that the company has maintained, and you have figured out the level of assets. Or can you then forecast the level of debt? Answer is yes, you can. What about retained earnings? Where will this come from? Retained earnings will come straight from the income statement. So based on the income statement and based on the dividend policy that hopefully you understand, you can forecast retained earnings. So what about the cash flow statement? If you have forecasted the income statement and the balance sheet, can the cash flow statement simply come out of those two financial statements? Yes. So you don't need to then separately forecast the cash flow. It comes out of the income statement and balance sheet. This next point is explicitly mentioned in the learning objectives, so you need to know this. Return on invested capital. This term shows up in many different places. What is return on invested capital? It is NOPLAT divided by net operating assets. NOPLAT stands for net operating profit less adjusted taxes. Effectively, what this is saying is operating profit is the money that is available to all investors, equity as well as debt investors. So you take all the money that is available to equity and debt investors and you then subtract the tax amount because that money is obviously not available. That is called NOPLAT, and this is something that you also see in corporate finance. And what's net operating assets? This is your total operating assets minus the operating liabilities. That effectively is your capital. Now, what do you think is the relationship between a company having a competitive advantage and this particular measure, return on invested capital? If a given company has a higher ROIC relative to other players in the same industry, and this higher ROIC has been in effect for the last few years. What does that mean? So you take a company like Apple and you compare it with other players in that industry. Apple will have a higher ROIC relative to other players. What is that telling you? What that is telling you, if a company has a higher return on invested capital, that means it probably has some sort of a competitive advantage. Otherwise, what happens? Otherwise, we have a mean reversion. If a company has a high ROIC and there is no competitive advantage, what will happen? That ROIC eventually will come down to some average level. On the other hand, if you observe a company that has a consistently high ROIC, then either there is some earnings manipulation happening short term, or the company actually has a competitive advantage. A related term is return on capital employed, which is not as important, it's not used as much, but this is simply ROIC before tax. So remember, ROIC takes the return and you subtract adjusted taxes. If you don't subtract the taxes, so you have the total operating income, then it is called return on capital employed. But as a word of caution, these terms are sometimes defined differently in different textbooks. The one that I would have you focus on is ROIC, and I would have you focus on this particular definition because that is what is given here. Now, just to check whether you are following me, here is a classic example of what might show up on the exam. So read this and tell me the answer. So this is a simple but very important question, and there are some key remarks here. 40% debt to capital ratio, so that is given, and this capital structure will remain. So let me just draw this out for you. We have a situation where we are saying that debt is equal to 40 and equity is equal to 60. This is the capital structure. You can say debt to equity is 40 over 60 or debt to capital is 40%. We are saying that this will stay. Then we are saying that the company is solidly profitable but the profits are going to come down. That means that there will still be profits, and we are also told that those profits are going to be retained. So what that means is that if the profits are going to be retained, then equity will actually increase. If all the profits are being retained, then relative to where we were, equity is going to increase. If equity is going to increase and we need to still maintain the same capital structure, then that means that debt also has to increase. So the best answer is A. Next, try this one now. The first thing we need to do is just recognize the ratio. It's NOPLAT that we talked about earlier divided by net operating assets. And net operating assets are generally PP&E and working capital. That's what we are told over here. In this particular scenario, we are told that the company is overstating depreciation. So if depreciation is very high, then what's happening to this number? This number is coming down. It's going to be understated. And NOPLAT is increasing a little bit. So if the numerator is going up and the denominator is coming down, then what is happening to the overall ratio? The overall ratio then is increasing. So the best answer is A. The next point, which I'll cover briefly because this is not emphasized in the learning objectives, is scenario and sensitivity analysis. The basic idea is straightforward, that whenever you do forecasting, you should have a base case where you take the numbers that you expect the most. But clearly with forecasting, you cannot be sure of what will happen. So you need to take different scenarios, and you see this over and over in different disciplines, that there is a distinction between what is called sensitivity analysis and scenario analysis. In sensitivity analysis, you just vary one variable at a time and see what's the impact. In scenario analysis, the overall objective is the same, but you change scenarios. So in a different scenario, multiple variables will be changed. Now we come to section 3, the impact of competitive forces in prices and costs. Whenever you forecast, your process must consider the competitive environment of a company. And what is the competitive environment of a company? It is the industry in which it operates. The CFA program curriculum loves Porter's 5 forces. So you see this in level 1. There is a long reading in equity on the 5 forces. So this material is important. Clearly, when you are forecasting a company's growth or the company's future, you need to understand the industry in which it operates. So here is a quick summary or a recap of Porter's 5 forces. And you should know this by now, but if you don't, then I'd say you pause the video and quickly refresh your memory on the 5 forces. So here are a few basic points now. If in a given industry, the forces are strong, then the return on invested capital will be low. So if you take the airline industry, for example, there is a threat of substitutes. So that puts pricing pressure. If there is internal rivalry, lots of competition, if this force is strong, then the pricing power is low. If suppliers are strong, then suppliers will sell you goods at a high cost. So that puts downward pressure on pricing power. If customers are powerful, then obviously that puts downward pressure. If there is a threat of new entrants, then that also puts downward pressure. So the key point to remember is, in a given industry, if these forces are strong, then the profitability or the ROIC will be low. A side remark here is whether government and technology or some of these other factors are forces or not. And the quick response is that in the Porter's 5 forces framework, these are considered factors, not forces. So what we are supposed to do is take government regulation and see how that impacts the various forces. Now, this part of the curriculum does an analysis of the beer market in different parts of the world. So it does an analysis of the beer market in Brazil, beer market in UK, and then there is a long example of the beer market in Russia. But I'm just going to take a small excerpt just to make sure that you understand what to do, and then depending on how much time you have, you can then read through these examples. But I'm giving you the scenario here taken from the curriculum of the beer market in Brazil. So here is what you need to do. Take each of these, figure out what force is being talked about, and the strength of that force. Is that force high, medium, low? Because that then can help you determine the pricing power. And one point that I'll emphasize over here, generally Porter's 5 forces is done in the context of an industry. But what this reading is doing is also then taking it in the context of a major company in the industry. So what is being said here is that, okay, based on Porter's 5 forces, there is a certain pricing power or certain ROIC in the industry, but then we happen to be talking about a big player in the industry. And obviously, if the industry has pricing power, then that company also will, especially given that this company that we are talking about has a larger market share. So before we go on, I want you to fill these 2 columns. So the first force is the threat of substitutes, and here the degree is medium. It's clearly not high. One could argue low to medium. Next point related to a particular company in the industry which has 69% of the market share. Economies of scale in production and distribution yield significant cost advantage. Price competition is limited because of the cost advantage and because of overall increasing beer volumes. So what force are we talking about? Internal rivalry. Now within this rivalry, the degree is low. So at least for this particular company, given that it dominates the market, the competition is relatively low. In the UK market, which is another example, there if you have several small players, then the rivalry is high. Okay, now inputs. The inputs are basically commodities. So this is the supplier power. Is the supplier power high, medium, low? This is also low because they are just providing commodities. If there is an issue with one supplier, the company can easily go to another supplier. So suppliers don't really wield any power. Next point is that most of the product is sold in these retail outlets, bars, restaurants, etc. And the owners represent a large and highly fragmented group. Whenever you see this highly fragmented, what does this say about customer power? When your customer base is fragmented, that means the power is low. Barriers to entry are relatively high. So this is the threat of new entrants. So that is also low. So what does all this say about the pricing power and the return on invested capital for the company that we are studying? The pricing power is high and the ROIC is high given this competitive analysis. Now, what you can then do is look at the UK example and then the Russian market.